What's up, folks? Herman Williams here with another lesson on managing your money and managing your investments. What do you know about SPACs? That's S.P.A.C.s. It's an acronym for Special Purpose Acquisition Companies. Have you ever heard of SPACs? Are you wondering how they work and why they have become more popular lately? Perhaps you're wondering if SPACs might be a good investment for you. Well, stick around. Today I'm going to explain what SPACs are, how they work, some pros and cons of SPACs, and how you can invest in them should you decide to. First of all, as I said earlier, SPACs are Special Purpose Acquisition Companies. They're also known as blank check companies, but more on that in a moment. In the beginning, a Special Purpose Acquisition Company is a company that has no commercial operations, and it is formed strictly to raise capital through an IPO or initial public offering for the purpose of acquiring an existing company. This is why they are referred to as blank check companies. Investors are essentially giving these companies money to acquire or buy a company or companies, but the investor doesn't know what company they will own a stake in, at least not initially. Now, SPACs have been around for decades, but they were often thought to be too risky by many institutional investors and retail investors alike. In recent years, though, they have become more popular, attracting big-name underwriters and investors and raising a record amount of IPO money in 2019. In 2020 alone, as of the beginning of August, more than 50 SPACs had been formed in the U.S., and they had raised somewhere around $21.5 billion. Also in recent years, a number of high-profile celebrities have formed their own SPACs. So how does a SPAC work? Well, SPACs are generally formed by investors or sponsors with expertise in a particular industry or business sector, with the intention of pursuing deals in that area. When a SPAC is created, the founders sometimes have at least one acquisition target in mind, but they don't identify that target to avoid extensive disclosure during the IPO process. This is how a SPAC sidesteps some of the cost and red tape associated with taking a company public in the traditional manner. Now, there's pros and cons to this process. On the plus side, it allows investors to take a stake in an acquisition company without some of the added cost of going public being baked into the price. However, there are some costs embedded in SPACs that the average investor may not be aware of. I'll touch on that more in a moment. On the negative side, initial investors have no idea what company or companies they will eventually own through acquisitions. You should also know that SPACs generally seek out underwriters and institutional investors before offering shares to the public. Now, this can be a good thing if you're thinking of investing in SPACs. At least you will know that larger investors have already done their due diligence before deciding to invest in a particular SPAC. So in some cases, you can find out which big investors are showing an interest in which SPACs. Now, the money that SPACs raise is placed in an interest-bearing trust account. Now, these funds cannot be dispersed except to complete an acquisition or to return the money to investors if the SPAC is liquidated. A SPAC generally has 2 years to complete a deal or face liquidation. In some cases, some of the interest earned from the trust can be used as the SPAC's working capital. After an acquisition, a SPAC is usually listed on one of the major stock exchanges. Selling to a SPAC can be an attractive option for the owners of a smaller company, which are usually private equity companies. First of all, selling to a SPAC can add up to 20% to the sale price compared to a typical private equity deal. Also, being acquired by a SPAC can offer businesses what is essentially a faster IPO process. Depending on how the deal is structured, the sellers may still have an equity stake in the company, they may hold critical patents, or they may simply be given a seat on the board of directors. SPACs have become more common in recent years, with their IPO fundraising hitting a record $13.6 billion in 2019. That's more than 4 times the $3.2 billion they raised in 2016. They've also attracted the attention of some big-name underwriters such as Goldman Sachs, Credit Suisse, and Deutsche Bank. Okay, so here are a few important things you need to know about SPACs. Although SPACs issue shares for roughly $10 and valued their shares at $10 when they merge, by the time of the merger, the median SPAC holds cash of just $6.67 per share. What this means is that if you initially invested $10 per share in a SPAC that has not yet bought a company, by the time they're ready to make that first purchase, the amount of cash that they have on hand has a median value of $6.67 per share. That dilution of value that's embedded in SPACs constitutes a cost roughly twice as high as the cost generally talked about around SPACs, even by SPAC skeptics. That's the embedded cost that I was speaking of earlier. It essentially dilutes the value of the shares that you own. Does that mean that you should not invest in SPACs? No, not necessarily, but you need to understand who is bearing the brunt of the cost of taking a company public. When you hear commentators say SPACs are a cheap way to go public, they are right, but only because SPAC investors are bearing the cost, which is an unsustainable situation. Now, although some SPACs with high-quality sponsors do better than others, SPAC investors that hold shares at the time of a SPAC's merger tend to see the post-merger share prices drop on average by a third or more. That's also partly because SPAC sponsors compensate themselves with what is known as a promote, consisting of shares equal to 25% of the SPAC's IPO proceeds. And since they did not purchase these shares with cash, it dilutes the value of all shares. So, with all that being said, why would anyone want to invest in SPACs? Well, the bottom line is there are actually a few very good reasons SPACs can be a good investment. First, in order to attract IPO investors, SPACs promise a very attractive return for simply allowing the SPAC to hold their cash for 2 years. SPAC shareholders that redeem their shares receive the full price of the units sold in the IPO with interest. Plus, they have the right to keep the warrants included in the units for free. Now, a stock warrant represents the right to purchase a company's stock at a specific price and at a specific date. So you could invest in a SPAC, wait for them to announce their target acquisition, and then if you don't like what they are buying, you can redeem your shares and get your money back with interest. Plus, you still own the warrants, so if your opinion of the deal was wrong, you still get another chance to buy into the SPAC at a preset price. Another reason SPACs can be attractive is they have the ability to take a small company that may have an excellent product or service, but not the resources to take the business to the next level, and they can fast track that business's growth exponentially. So if they make good choices and they have the right expertise on board, you could see your investment grow at better than average rates, even with the initial dilution in value. The bottom line is investing in SPACs for the long term can be risky. After all, you don't even know what business the SPAC will own when you make your initial investment, and you don't know if or when they will be able to increase the value of the company they do acquire. But when you factor in the option to get out with a profit if you don't like the initial acquisition, all of a sudden it doesn't look so bad. Studies that I have seen show that on average, those who redeem their stock at acquisition end up with an annualized return of around 11%. That's not bad, and you'd be hard-pressed to find that kind of guaranteed return anywhere else. If you're going to consider investing in SPACs, I recommend you try to find out as much about its founders and its leadership team or board of directors as possible. This will give you some insight into the character, expertise, and goals of the SPAC. It may also give you some idea what sector or industries the SPAC may be targeting. If you decide you want to invest in SPACs for the long term, check out the link in the description for a look at 8 different SPACs that some consider a good buy. I will also include a link to information on 3 different SPAC ETFs or exchange traded funds for you to review and compare. Now please keep in mind that this is not an endorsement to buy any security or fund. This is for informational purposes only. If used properly, SPACs can give you options for managing your cash reserves. You just have to be open to thinking differently about how you manage your money. Always weigh your options, but be open to new ideas and new behaviors. And like I always say, if you change your behaviors, you can change your life. So until next time, behave well.